Hey, good afternoon, everybody. This is Chris McKeffey, Head of National Sales here at BX Partners, here to welcome you to today's edition of BX Presents, where we're going to be exploring, I think, the very timely topic of reimagining fixed income for the new environment. With us today are Young Lim and Jonathan Brown. Okay, Young is with Folio Beyond. Jonathan Brown is with Robinson Funds. They both offer very unique fixed income strategies.
Is the channel going to stay intact, or do we actually see that rates are going to rise from your perspective?
Yeah, I think it's our view that, as you correctly pointed out, the channel hasn't, it's still intact. It hasn't been broken. But I think there's 10 reasons to think that rates could continue to rise from here versus, go lower. Obviously, there's always chatter about yield curve control, which could, put a cap on rates and keep the channel in on track. But as of recently, we've started to see, even more stimulus hit the pipeline. The latest 1.9 trillion. We're hearing there's going to be another 4 potentially announced here, by the Biden administration for infrastructure spend. We're seeing economic growth pick up, which is generally a backdrop for rates to continue to rise. And you're also hearing, inflation concerns coming directly from the companies themselves. That's ranging from home builders to toy makers who are basically sounding the inflation alarm on, raw material costs, wage inflation, et cetera. And you've heard that from 3M, from Walmart, from Williams-Sonoma to Mattel. So, there's quite a few reasons to believe that, inflation is going to continue to pick up or rates should continue to rise in this backdrop.
Fair enough. Young, maybe similar question for you. Are you building in any effort to go longer duration, or are you really set that short duration is the way to go, given what the long-term trend looks like for rates?
In the current environment, or at least up until a couple of months ago, the curve was flat, so there wasn't really much of a benefit to extending out on the curve. But as the curve has steepened, although it's somewhat flat from a long-term historical perspective, the additional pickup you're getting now versus short intermediate instruments does give you some reason for extending out duration a little bit, but it has to be done in a modest manner given the overall risk framework. So we're still, the model is still lower risk in terms of being shorter intermediate duration, and especially with the credit exposure being closer to the short end.
So maybe walk us through some of the inflation concerns, or how you're forecasting inflation or thinking about inflation in terms of some of your strategic thinking.
We're not entirely concerned about immediate runaway inflation. We do think that on the opposite hand, there are deflationary and deflationary aspects of the market, such as
right.
Technological advances and disruptive technologies that are going to hopefully help keep a lid on it. However, we very well could see over the next few years inflation continuing to rise, and even coming from the Fed themselves, they're trying to let inflation run hotter than their 2% target for an extended period of time. So they really haven't given us any reason to sort of doubt what they're going to do over the past decade or so. So it's reasonable to assume that we may see some pickup of inflation.
Right. No, makes sense. Young, obviously, short and long end in your algorithm. When you have changes like the Fed coming out and saying they want higher inflation, how do you think about that? How do you frame that in terms of some of your research?
Sure. Well, the inflation component comes directly into play in our TIPS part of the portfolio, which we currently don't have any exposure to, but we are looking at relative value comparisons across the board, comparing option adjusted yield, for lack of a better term, to look at relative value. So when it comes to TIPS or inflation-related products, to bring everything back to a nominal yield basis, we do look at consensus CPI forecasts and bring everything to a nominal yield basis.
Jonathan, maybe you can walk us through just the difference in the math, I guess, just from a bond perspective, with rates being dramatically lower, and obviously the coupon being a significant part of returns historically, especially given where we came from 2 or 3 decades ago. I know you guys have written a white paper recently. Maybe you can just give us a quick background on how the math is working against bonds at this stage.
Flash forward to today, and you're looking at the ag having about a 1.5% yield with call it a 6-year duration, which means that it only takes about a 6 basis point increase in yields on a given quarter to erode all of your gains. And anyone could look at year-to-date returns and see that most fixed income indices have negative returns year-to-date as rates have backed up. So we believe the traditional fixed income portfolio no longer really provides that principal protection that it once did. And then in terms of the correlation, what once was good for stocks was bad for bonds and vice versa. We've seen correlations sort of converge here, and with the Fed since the financial crisis, generally what's good for bonds is good for stocks, what's bad for bonds is bad for stocks. So it's not clearly apparent to me that you're really getting that diversification component from your traditional fixed portfolio as well either. So it really causes one, in our opinion, to have to step back and re-examine how it is that they're structuring their fixed income portfolio.
Right.
So some of the other sectors that are interesting for us is the short end of the high yield corporate bond market, because the duration risk has been a big factor, a big risk factor for anyone on the high yield side. We're shorter on the duration, and with some short dated high yield exposures, you're able to get higher yield but maintain a short duration. There are other areas such as high yield munis, which the models started allocating to on a very small scale a couple of days ago. And mortgage REIT is another interesting category, but the mortgage REIT market, at least from our risk perspective, is still too volatile to fit into the portfolio.
Sure.
But there could be some value there.
So how much credit risk are you taking, and is now the right time in the cycle to be taking credit risk?
Treasury and agency exposure acts as a ballast, and it is a good counterbalance against any kind of flight to quality scenarios. Certainly that exposure will be hurt in a rising rate environment, but in a rising rate environment, corporate spreads are likely to tighten, and we've seen bank loans and short dated high yield bonds perform well in a yield curve steepener.
All right, fair enough. Jonathan, let's just go directly into your portfolio. So in terms of your portfolio breakdown, we're seeing a larger exposure to bank loans and to corporate credit. And then we're also seeing securitized debt. Maybe you can walk us through other key areas in the portfolio and what you're thinking in terms of your main exposures today.
Yeah, so again, we're heavily weighted in the bank loan and high yield space as is apparent in what we just talked about. From the securitized debt standpoint, more of the agency, MBS, CMBS. We're looking at that as Young said, it's sort of a ballast to the portfolio where you have Fed support, relatively high quality as well. And then, some of the other areas that are fixed income or equity income are, we do have some exposure to MLP and REIT closed-end funds. And that's really a reflation type call. We see the economy, continuing to progress and normalize. And what's unique about our strategy, which we haven't gotten into too deeply, is we approach our our strategy by investing in closed-end funds. And so,
Right. And what kind of discounts are you seeing now in terms of some of the spreads against the within the closed-end funds?
So as a whole, we're still seeing wide discounts. So I think our portfolio, as of latest close was closer to a 7.5%, 8% discount to NAV, which by almost all historical measures is extremely wide. But when you really look at a comparable time frame, we looked at 2010 to 2013 when the Fed had pinned rates, short-term rates near zero, and were supportive of the economic expansion. We saw discounts go to premiums. So in that environment, we see history repeating or rhyming. Now with rates short rates remaining lower for longer, we think that these closed-end funds could trade premiums, and if our analysis is right, that could be worth another 7 to 10% of capital appreciation that you're not going to get with any other traditional fixed income strategy. And so,
there are certain similarities, I think, with Jonathan, although you have a large exposure as well to agencies. Maybe you can walk us through the key points within your current structure.
The differences are that we try to generate, call it 20 to 35% of our overall returns from sector allocation alpha. So we do have income as a good part of our total returns, but historically, anywhere from 25 to 35% has come from rotating from one sector to another, depending on the relative value relationships and changes in the risk profile.
Right. All right. Thank you. Very interesting discussion to each of you. Thank you for your time.